Welcome to this Executive Briefing Explainer. Today, we're decoding the new era of corporate governance, ruled by permanent capital. If you're managing investor relations right now, the way you look at your shareholders is fundamentally different today than it was even a decade ago. The entire landscape of ownership has been completely rewired. And understanding this shift, well, it isn't just some academic exercise. It is absolutely crucial for your corporate survival. Here's our game plan. We'll start with the passive investing boom, separate the market myths from reality, and then break down the two edges of this sword, stability and volatility. Finally, we'll open up a playbook for navigating this new hidden power. Let's get right into it. Section 1. The passive investing boom. Have you noticed your cap table getting eerily quiet on active trading days? Let's look at the sheer scale of the paradigm shift that's completely transformed the market landscape since the 2008 financial crisis. Okay, let's really think about this number, 88%. Today, the big three asset managers, BlackRock, Vanguard, and State Street, are collectively the largest shareholder in an astonishing 88% of S&P 500 firms. They are literally the unquestioned titans of the market, holding massive, permanent stakes in virtually every major company. To really grasp how we got here, consider this historically unprecedented swing in investment behavior. Between 2008 and 2015, investors yanked a massive $800 billion out of active funds. And at the exact same time, they poured a staggering $1 trillion into passive, index tracking funds. Driven mostly by a desire for lower fees and broader market returns, this was a massive rewiring of the entire market machinery. Moving to Section 2. Myths versus market reality. Before we look at how this impacts your day-to-day, we need to debunk some of the conspiracy theories floating around out there. Peer-reviewed research, like this really fascinating study out of the University of Amsterdam, confirms that the big three aren't some shadowy puppet masters orchestrating a grand corporate conspiracy. No, their massive stakes are simply the pooled investments of everyday people. But, and this is a big but, because of their massive size, they exert a very real hidden power simply through their permanent ownership. Let's break down what this actually means for you on the ground. Passive ownership is an investment strategy tracking broad indices rather than picking individual stocks. Because they track these indices, these funds can't just sell their shares if they get unhappy with your quarterly numbers. The classic Wall Street walk, where ticked-off investors simply dump their stock and leave, is effectively gone. They are essentially permanent capital locked onto your cap table. Which brings us to Section 3, the first edge of the sword, stability, and the protective side of permanent capital. For an investor relations officer, this permanence actually brings some pretty notable benefits. Research shows that massive passive ownership reduces informational asymmetry. Why? Because these mega investors leverage their massive influence to pressure management for highly detailed disclosures, like more frequent and robust earnings guidance. They want to know exactly what is happening inside the machine at all times. And this push for transparency has tangible rewards. It actually lowers the cost of equity for liquid firms. Plus, because they're stuck with you for the long haul, their focus promotes long-term value instead of frantically chasing short-term quarterly earnings. They're the ones championing sustainable ESG principles, ethical risk management, and diverse leadership initiatives. Ultimately, they just want a stable, sustainable market. But here is where we pivot to Section 4, the second edge of the sword, volatility. This is the dark side of passive dominance, and as an executive, you absolutely have to recognize this dynamic. The trade-off for all that long-term stability is steep. Sure, you get reduced informational asymmetry and capital stability, but on the flip side, you get higher agency risk because passive investors aim to just match the market, not beat it, meaning they might not meticulously police every single management decision. But far more dangerously, we're seeing a severe reduction in day-to-day active trading liquidity and the rapid introduction of systemic risks from investor herding. Let's drill down into that liquidity issue for a second. Because index funds rarely trade, they mostly just buy and hold, they fundamentally dry up day-to-day market liquidity. Now, you might be thinking, hey, that protects our stock in bad times when volume is down anyway. And you'd be right. But here's the catch. It severely restricts your company's ability to benefit during good times. If there are fewer active buyers and sellers, your stock simply can't move as fluidly as it used to. And things get even more volatile from there. To generate extra income, these passive managers actually lend out shares to short sellers. We are talking about hundreds of billions of dollars in indemnifications here, BlackRock at $130 billion and State Street at $320 billion. Now, in good times, this practice operates totally invisibly, but during times of extreme market stress, that could severely impair market liquidity, creating massive systemic hurting and wild volatility that is completely out of your control. So how do you handle this? Let's move to Section 5, open up the IR playbook, and figure out how to navigate this hidden power. With these enormous volatility and liquidity risks in mind, you have to understand how the big three actually operate. They exert their power implicitly. They are generally pretty reluctant to publicly challenge management in a messy proxy fight. Instead, the real deals are shaped in private engagements, behind closed doors. In fact, because of their sheer size, corporate executives are actually preemptively internalizing the Big Three's objectives right into their business plans. And remember, these funds are looking at portfolio-wide risk mitigation, which often overrides the specific nuances of your individual company. So, here is your action plan. First, you must thoroughly understand their annual stewardship guidelines. Second, proactively align your communications to their priorities, but without surrendering your corporate independence. Third, you've got to master those closed-door private engagements, because that is where the voting decisions are actually made. And fourth, closely track regulatory shifts from bodies like the SEC in the US and the FCA in the UK, because regulators are keeping a very close eye on this concentrated power. What you really need to take away from this explainer is a fundamental mindset shift. We have officially crossed a tipping point. The age of widely dispersed democratic shareholder capitalism, where thousands of active voices shaped the market, that's over. It's done. It is rapidly being replaced by highly concentrated institutional ownership. As researchers at the Costello College of Business so brilliantly put it, if this unrestrained growth of passive funds continues and individual active investors disappear, the market shifts from a democracy to a kingdom ruled by the Big Three. So as you walk into your next board briefing, take a hard look at your cap table and ask yourself this. In a market ruled by permanent capital, with its dual edges of extreme stability and hidden volatility, is your corporate governance strategy built for a democracy or a kingdom? Thanks for joining me for this explainer, and I'll see you next time.